Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this INDepth. We're delighted to look at the health of the Australian property market with partner and head of healthcare real estate at Barwon Investment Partners, Tom Patrick. Welcome.
Thanks, Laurence. Great to be here again today with you.
My pleasure. So, Tom, you've recently made the argument that we've reached an inflection point in the property market. What signals are giving you the confidence that we're about to enter a new growth phase?
Yeah, I have made that statement. I'm not the only one, I would add. I think if you've been keeping an ear to the ground on the commercial property markets in Australia over the last few months anyway, I think the sentiment generally with most investors is absolutely we're at that inflection point. Another way to put it is, bottom of the cycle. We've had a downward trajectory really in terms of total returns and capital values and things like that associated with, global macro issues and rising interest rates and inflation and so forth. But the leading indicator there is the continued stabilisation of global interest rates. Similarly here, and indeed we're starting to get some early signals that those are being cut. So that starts to give commercial property investors, given the correlation that we've seen with interest rates and cap rates, that starts to give commercial property investors a bit more confidence that we're hitting the bottom of the cycle. You see that start to play out in unit pricing and in valuations and cap rates as well, which across most sectors have really stabilised, including some of those segments which have been less favourable. So that's a really good starting point. There's a myriad of other factors in there as well when we start to think about tenants and how they're holding up. But really where that shows up, I think, is when you start to look at what the market's saying, and our transaction volumes are starting to increase. We on the other side of the cycle, we see transaction volumes decline as a consequence of a buy-sell spread. As people gain more confidence, that buy-sell spread will narrow and you start to see more transactions completing, and we're definitely seeing that in the Australian market.
And the other element to this, Tom, is for many years, the golden goose for investors was the debt side of the ledger. What is it that you now feel is showing that investor sentiment shifting back towards the more core approach?
Yeah, well, I think debt and private credit specifically is still very popular, and I don't see that changing overnight, albeit, there's some noises out there with compliance and different funds and things like that, which is somewhat sensational. But fundamentally, why it has been so popular is the spread that private credit's been able to offer over the cash rate when yields have been low relative to, say, traditional commercial property segments. And that's been a consequence of the macro environment over the last couple of years. We are seeing that reverse similarly in the same way that we're seeing transaction volumes increase. One of the fundamentals that's occurring there is we're starting to see the spread over the 10-year bond rate to commercial property yields get back into that more 150 to 200 basis point range that we expect to see. So, with the 10-year bond in the low fours and, commercial property yields across Australia at or around, say, 6, all of a sudden we're starting to look like nearly 200 basis points. So that gives investors confidence again that we're hitting a more normalised market, fairly standard spread over that bond rate, which starts to, deliver attractive yields to people. So the income part of the equation starts to become important. But then you've got to consider as well over your medium term, your expectations around capital growth. So the one thing that private credit won't do is give you growth. And commercial property, particularly now where we are in the cycle, we have some expectations around that.
Within commercial property, healthcare is something that you're very passionate about and know a lot about.
Yes.
How does it compare, and why is it so resilient if you were previously allocating to something like office or retail or industrial? What does healthcare offer in particular?
Yeah, well, first of all, it offers great returns. Healthcare real estate's been the second best performing segment of the commercial property market in Australia for the last 10 years or so, only just pipped to the post, if you like, by industrial. So, that's a good starting point. Over and above that, people will talk to the defensive attributes of healthcare. Resilient sector, 70% of the funding that comes to our tenants is paid for by our state and federal governments. It's the second largest part of our economy at $220 billion a year expenditure. So people get that generally and they think it's resilient. It is, but we like to point out that it's very much a growth space as well. Got very strong kind of macro tailwinds that are driving growth in that segment with an aging population, increasing levels of, chronic disease and comorbidities in society that require care, and changes to technology are all factors which we think will continue to drive that. So the demand supply profile that you see in healthcare is quite frankly extraordinary. It plays out at very low vacancy levels, very low incentives and things like that. But fundamentally, I think we've got a great sector of the economy, very, very well supported by our governments, that has a terrific growth profile. The other thing to say, and I think we're going to see more of this cycle, is that it is one of those alternative real estate segments that global institutional investors are very much looking to get set in. You rightly point out that there's been a bit of a shift away from the preference from, say, the traditional office, retail, and industrial. Still very, very strong, and don't get me wrong, they will be the large part of global portfolios, for a very long time. But we're increasingly seeing interest in data centers in the living sector and in healthcare and life sciences as well. And we think that's going to, as a result of that demand, drive some good results for the segment over the next 5 years as well.
Picking up on that, Tom, the interest in data centers, student accommodation, build to rent, these alternative plays, where do you see them sitting in a portfolio? Are they satellite to a core of commercial pockets?
I think they're very much becoming part of the core portfolio for global institutional investors and indeed domestic institutional investors, as they should be for domestic, sophisticated wealth clients as well. The reason being is that they add a significant amount of diversification to those property portfolios, which is uncorrelated. So if you're thinking about how we can construct our portfolios at a very high level, shares, cash, bonds, alts, so forth. When we think about the property component of there, we want a little bit of diversity in that as well. When the office segment's struggling, healthcare, should be standing on its own 2 feet and doing very, very well. So I think that's probably one of the main reasons that there's been so much interest in it, is the additional diversification they can get, which is uncorrelated to those traditional segments. Equally, I do think that strategically people look at it and go, gee, again, the growth thematics in these segments, whether that's data centers, whether that's living, whether that's healthcare, it is somewhat undeniable, and they want to have a position in that. They want to have an exposure to that so they can benefit from those tailwinds as part of their investment.
Now, Tom, Barwon Investment Partners has a real specialism that you lead in terms of healthcare real estate. Can you talk to what some of those assets are that you find particularly compelling in the market, by geography, by subsector? What are you looking for at the moment?
You're right. We do have a specialisation. We've been investing in the segment for 10 years now. We're one of the leaders in the Australian segment, and probably the third largest owner of those assets. And by far and away, we've got the most diversified portfolio, and that's by design. We've wanted to build out our portfolio over time to include diversity within the healthcare subsectors. Areas of that market that we particularly like at the moment, we still like private hospitals, notwithstanding everything that's going on with HealthScope. There are spaces in there that are very exciting. Particularly short stay orthopedic facilities and things like that can be very, very accretive to our yield and our value. So we're investing into that. We've just finished around about $250 million worth of projects in that segment, one in Queensland and one in Adelaide that we're very proud of. And for us, I think, primary care, medical centres has always been a big part of what we do. And we continue to have a strong conviction for that segment. It really is the backbone of healthcare in Australia. And we think that in time, dealing with some of the issues that most health economies have, we're going to require the primary care segment to be a real big part of the heavy lifting that needs to be done for our population. So still big believer there. And then probably just lastly, and I think more in the medium term, that kind of public-private intersection where we've got not necessarily infrastructure style PPP, big public hospitals, but where the public sector or the state governments need outpatient facilities that are perhaps adjacent to their existing base hospitals and things like that, and where we can marry up with private sector operations as well and get a really nice mix. That's something we're exploring across a number of projects. Life sciences is something that people are talking a lot about. We're a little bit cautious on that space. I think, we've been investing in labs and things like that for a long time. But I don't think we quite have the market in Australia that the US does or the UK indeed for true big lifestyle life sciences investments. Nonetheless, there's a place for that in our portfolios, appropriately selected.
So you've got the investor sentiment shifting, a great time in terms of the cycle and the demography stacking up. So an accretive addition to portfolios. Thanks for sharing your insights, Tom.
Pleasure, Laurence. Thanks for having us along again.